A lot of traders struggle with the same question. How do I know if this is a liquidity sweep or a real market structure shift? And because they don't understand liquidity, they start second guessing everything. Every high, every low, and every candle. Liquidity then becomes this confusing monster that overwhelms them instead of guiding them. But it doesn't have to be that way. Mastering liquidity comes down to understanding logic and price behavior. And once you understand that, liquidity becomes simple, predictable, and incredibly powerful. That's why in this video, I'm going to give you the keys to liquidity, the same principles that finally made everything click for me after years of confusion. So make sure you stay to the end of this video, because after watching this video, you're going to see liquidity completely differently. By the end of this video, my promise to you is that you're going to know with high certainty when a turtle sweep is a turtle sweep, because I know a lot of you struggle with, oh yeah, but how do I know if it's going to be a turtle sweep / liquidity sweep or not? By the end of this video, you're going to be able to know that. You're going to be able to know with high probability and high certainty which low or high will be used for the turtle sweep / liquidity sweep based on the price behavior logic I'm going to share with you as we progress in this video. But before we get into that, let's just get into the basic foundations that are going to allow you to understand more deeply what I'm going to share with you later on in this video. So simple things first. What is liquidity? Liquidity is stops in the market resting above highs and lows, and the idea is around this is that when traders are trading, they put their stop losses and stop orders above highs and lows. This is what we then view as liquidity within the market, as they are pending orders. The key, and this one you're gonna have to listen up, the key to understanding how to trade liquidity, because everyone's always getting confused with liquidity, right? But the key to understanding liquidity and how to trade it in the market lies in understanding market behavior, how the market behaves. Because if we're going to understand how the market behaves, we know what the market most likely does at certain points. We're then able to form a narrative which then gives us context to why prices behave in this way on the lower time frame. Now, one thing you guys need to understand is that the market is either seeking liquidity or inefficiencies. So if we can frame the idea of where price is most likely to reach for on the daily chart based on these functions, that okay, price is only ever reaching liquidity or inefficiencies, we can have a high probability draw on liquidity, which is then our quote-unquote bias / daily bias, which is then essential for anticipating price behavior. And the reason why I say it's essential for anticipating price behavior is because if we know where the market is drawing to on the higher time frame, it's easy to frame our day trades within that narrative. We then have an anticipation and an expectation of how price should move on the lower time frame. And the reason why I say use the daily chart, right, is because it just makes things easier. The daily chart literally solves one of the biggest problems, which is daily bias. Because you got to remember one thing, price is fractal, right? So if we can predict which direction the candles are going to print, we have just anticipated a day's worth of trading simply because of the fact that we're doing our analysis on the daily chart. And then what we then do is we use that information of where price is likely to print on the daily chart to look for certain price behavior based on smart money logic in that direction of where we're anticipating price to reach for on the daily chart. And that's one of the important keys here, because a lot of people say, oh, I'm doing my analysis on the 4-hour chart, I'm doing my analysis on the hourly chart. Okay, yes, that's good. But if you just simply shifted your perspective on the daily chart using the same information you're breaking down on an hourly chart and a 4-hour chart, you just give yourself a better advantage, because now you don't need to know exactly how the day is going to react, because if you can predict those next candles, you've already solved your daily bias problem. So just by virtue of you just using the daily chart, from shifting from a 4-hour to a daily chart, you will have a lot easier time in terms of actually predicting where price is most likely to go. If you remember the two functions of price, it's either seeking liquidity and seeking efficiency. So if we can look at price and see where's the nearest inefficiency, where's the nearest liquidity on the daily chart relative to where price is, whichever price is closest to you based on where it's currently trading at, that's going to be your most likely draw. And then we take this information and then we apply it to our day trades, and then we look at the price behavior based on smart money logic of how price should behave because it's supposed to be bullish. And what do I mean by price behavior? If price is bullish and we believe that the market is manipulated based on the logic of power of 3, right, which is accumulation, manipulation, distribution, we expect a measure of manipulation within the markets before price goes higher, and that manipulation is typically a move in the opposite direction of the true intended direction. And what do I mean by this? In simple words, if we're bullish, we want to see price move lower before it moves higher. And the smart money logic behind this is that that move lower induces selling into the market, which generates the counter liquidity to facilitate the true directional move. And that's what you can see in this illustration here. We see that move lower. Everyone, all traders are thinking, oh no, the market is a sell, market is a sell. Okay, the market is engineering liquidity. And then the market reaches a key level or key low and then reverses from that key low. People are trapped. People have sold into the idea that the market is sold because that's the manipulation. And then the true direction of price then starts to unfold. Now, where does this inducement usually take place? And by inducement, I simply mean manipulation. Where does this inducing, this sucking in, of people in the wrong direction usually take place? Well, the market likes to refer to key liquidity points, which is usually at previous day's highs, previous day's lows, session highs and session lows. These reference points is what the market usually likes to refer to if it's seeking liquidity for our day trade. So if we know that price likes to refer to these key liquidity points before it moves higher or lower, and then now we have a high time frame draw on direction, in the example I gave, we're anticipating price to go higher, what do you think that means price is going to reach for on the lower time frame? Think about the logic behind that. And what do I mean by the logic behind it? If we have a high time frame draw on the daily chart, right, because remember, we're bringing our analysis from our daily chart down to a lower time frame, and if we know that price tends to manipulate when it's manipulating at opposing liquidity, and we know that price likes to refer to previous days highs, previous days lows, session highs and session lows, that means that if price is bullish, we can anticipate that price will seek to trade below previous days low and session lows and reject this because we're bullish on the higher time frame. So it's going to reject this on a lower time frame, giving us that manipulation element, therefore giving us the high probability liquidity sweep. And this is the exact logic to how liquidity sweeps and turtle sweeps happen, because we're bringing a high time frame perspective onto a lower time frame chart. And if we're bullish on the high time frame, we know price wants to go higher, right? If we then see price taking out these key liquidity points at the right time of day, we're going to get into that in a minute, that's a signal to you as a trader who understands the logic behind price behavior that, okay, this is most likely a high probability inducement, because you know the true direction of where price wants to go. And by blending time of day, like the 9:30 New York Open, right? And think about this, that 9:30 Open is the time where we start to expect manipulation to happen, and we already have our high time frame draw / bias. We can anticipate the manipulation to take place, and as liquidity trader, we now know where it should take place, because think about it, what does the market prefer to seek for in terms of liquidity? Previous day's highs, previous day's lows, session highs, session lows. So if we know that we're bullish and we have a high time frame draw / bias, right, and we see from 9:30 Open at the start of that time, we see price take out a session low, previous London session low, or the previous day's low at this key time of day, where we anticipate manipulation to happen because it's time before price. We're now timing the market. Do you see how this creates a high probability condition that this is most likely a turtle sweep / liquidity sweep? And this is the best part, because all we just need to do is literally wait for this to take place. And when everyone is like, oh no, sell, because they see price dropping from the 9:30 Open, we're getting ready to buy because we have insight to price behavior. We have insight to how price should behave if it's bullish or bearish. So that sends the signal to us that, okay, we need to start looking for buys. And the best thing is that you don't even have to trade it as it's selling. We simply just have to wait for a lower time frame confirmation of the reversal, and then we then engage in price after we've seen the confirmation that, okay, maybe it's done selling. And that confirmation could be an inverse fair value gap, could be the market structure shift, and then we just sit in the true direction of the move, because we've now seen the sell move happen. Price has now showed us that it's now ready to start turning around, to now start trading within the true intended direction based on the confirmation it's given us. And then now we're just sitting for the much more simple, easy trades. And that's the key here. You just wait. And a lot of you just can't sit on your hands, because if you have all this information now, you know exactly where it should react from. If it's bullish, you know what time you should start looking for that reaction. You know the confirmation you should be looking for, and all you need to do is just wait for that to unfold, and then you then have a great deal and a high probability trade on your hands. And this is just a visual illustration of it. We have previous day's low here, price is trading here, 9:30 opens, price starts selling, The people who are uninformed, they're looking at that as, oh no, prices are sell, sell, sell. They start selling. The market is generating liquidity. Price hits that key liquidity, that previous day's low, and then we have our confirmation as price trades into that key level, right? And then price moves away. And I know you might be thinking, okay, Gerald, but what if there's a previous London session low, there's a New York session low, and then there's the previous daily low? How do I know which low is going to be used? I'm glad you asked, and I'm glad you even thought about that, because now you're thinking the right way. How do you know this? Okay, we can never know 100%, but we can have a high probability certainty based on a few things. The key to knowing which liquidity will be used is by understanding close proximity. By this, I simply mean that whichever key liquidity is relatively close to where price is trading at, so that could be a previous day's low. So if price is trading near a previous day's low, if price is trading near the London session low, if price is trading near the New York session low, if price is trading near one of these key liquidity reference points close to the time of 9:30, the one it's trading the closest to based on where price is currently at and where that key liquidity is, that is the one price is most likely going to use to have that manipulation element in it, simply because it's a key reference point and it's the easiest one to get to, deeming it low resistance, because price does not have to do a lot to get to that low. And the logic here is simply that you wouldn't anticipate a super deep opposing move if price is supposed to be bullish. You want to see that energy being put towards the intended direction. So in essence, price will seek low hanging fruit manipulation. And guess what? Because you're not trying to catch the bottom and you're simply trading the confirmation of the manipulation, you don't necessarily need to know how deep the manipulation is gonna go. Even though you don't expect to go deep, you don't necessarily need to know how deep it's gonna go, because what you're doing is just waiting for the confirmation that the manipulation is done. And what does close proximity look like? So let's say we had our previous day's low all the way here, right? And let's say price is trading here currently at 9:30 open, and let's say we had a London session low here, right? Remember, session lows, session highs, previous day's lows, previous day's highs, key reference points. Okay, there's a London session low there. That's a key reference point. Relative to where the market is opening and where it's trading at now, to that key low, that's relatively close in distance to price. All you need to do is think about, okay, where's price currently trading at? How far is this key reference point in relation to where price is? Okay, is it relatively close? Okay, that's the one. The one that you see closest, that's the one that's gonna be most likely used. And what you do, you just wait for that one to be used, and you just wait for that confirmation. Because if you think about it, 9:30 opens here, do you think price is going to go all the way to previous daily low just for it to manipulate if it needs to go higher? The chances are most likely not. Can it do it? Yes. But the chances are most likely not. So you have a high probability chance that this one is the one they're going to use. And if you then further confluence this, let's say you have this London session low here and you're trading NQ, right? And you trade NQ and ES. Let's say price trades into the London session low, NQ takes the London session low, and you see ES failing to take the London session low. That's further confirmation that, okay, that's the low that's going to be used. Do you see how you're then confluencing many things together just to build a high probability narrative that, okay, the market does want to move higher? And I know what we're thinking, okay, Gerald, you said close proximity. What happens if, let's say, all these key reference points are too far away? Oh, well, that's a very good question, and I have an answer for you for that. See, you're thinking right. You're thinking right. Okay, cool. What happens if the session lows or the previous day's high and lows are too far away to where price is currently trading at 9:30, right? What we simply then do is use the most recent high or low that formed on the 15-minute chart prior to 9:30 open. And this is a perfect visual illustration of that. So at 9:30 open, we're bullish. This is a bullish example, right? You say, oh, you know, London session low is all the way down there. It's too far away. The previous day's low is too far away. What you then need to do is just use the reference point of before 9:30 opened, where's the most recent high or the most recent low that's formed on the 15-minute? And obviously because we're bullish, we're looking for that. Where's the most recent low that formed on the 15-minute? And then you just do a look back. 9:30 is here, you do a look back. Okay, we see there's a low that formed here. That's the low that we're going to be targeting for our manipulation to happen. And that's all you need as a key reference point in order for you to see manipulation happen, and in order for you to act after seeing confirmation. And obviously vice versa if you're bearish. And that's all there is to trading liquidity and understanding price behavior, is that we know what we're looking for. We know when it should happen by virtue of the time. We know where it should happen, and then we just trade the confirmation. And then what this does is gives you a super x-ray on how price behaves in terms of going from one liquidity point to the next, and how price should behave, whether it's bullish or bearish. And I know you might think, okay, I know where I'm entering, so what then becomes of my targets? What my target? Okay, if you know that price is bullish and it's primarily rejecting previous session lows and previous daily lows, your draws on liquidity as price progresses is going to be previous session highs, previous days highs, and then the ultimate draw on liquidity. Those then become your targets for you to frame your trades around, and then that's it. You now know where you need to be getting in terms of liquidity points in price, and you know where you should be targeting in terms of exiting in price. And that's the full framework to liquidity. Okay, let's go take a look at a few examples. So here's an example of what I'm talking about. At 9:30 we're thinking, okay, where's the most recent session low or previous day's low that is relatively close to where price is currently at 9:30? There isn't. There's a New York session low that's right here. There's the current daily low that's there. So that's kind of far in price. Okay, that's too fast. We shift our focus to the 50-minute reference points. Okay, where's the most recent 50-minute higher low that's formed prior to 9:30? Because in this example, we're bullish. We're thinking, where's the most recent 50-minute low for a target, for a manipulation target that's formed prior to 9:30? And look at that. We look back, and would you look at that? The most recent low happens to also be the same low as the New York session low. So that just makes it a high probability confluential manipulation target. So let's go see what happens. So look, at 9:30, price opens, price trades lower into that key reference point, and then look, boom, price starts to move away. And then let's go see if we had some confirmation as price took out this low on the lower time frame. So as you can see, price trades into that low. And remember, we're expecting price to engage in that key reference point before we engage in price. That's what we want to see, to give us that signal that, okay, we should be looking to engage. And then look what happens. Price sweeps it, moves higher, and look at this, gives us a nice market structure shift to the upside after taking out our key reference point, and would have just entered based on our confirmation. So it could have been 50% of this range. Anything below 50% of this range would have been able to enter. There's an inversion fair value gap here that would have entered on. Entry there, stop at the low that made the market structure shift. Price gives us a deep retracement, but doesn't take the low out, so you still would have been in the trade. And then that's it. Look how beautiful that is. And then we have a trade. And that's it, guys. That's it. And we didn't even need to know how deep it had to sweep this low, because it could have gone deeper. Yes, it could have, but we didn't even need to know that. We just had to wait for the confirmation after the low had been taken, and that's all we'd be looking for. And this all comes down to the fact that we understand where price should be manipulating in terms of absorbing and generating liquidity, and we also understand when it should do it. And if you can put those things together like I've showed you, that's what you get. These are the results that you're able to get. Okay, let's look at another example. And in this example, bullish again. So for the sake of hindsight, we know that price wanted to trade higher. So again, at 9:30, what are we looking at? Where those close proximity reference points? Are there any nearby to where price is currently trading at? Okay, yes, there's a London session low very close to the 9:30 open. Do you think price is going to have a hard time taking out that low? If it's a low that we know price likes to manipulate at, if we know it's a key reference point for price, do you think price is going to have a hard time trading into this low based on where it's currently trading at and where this low is? Of course not. That's the target. And then look what happens. Price trades into it, sweeps that London session low, key reference points, and let's see if we had some sort of confirmation on the lower time frame. So then look, 9:30 is around here. Look, price starts to run. Everyone's thinking, oh my god, yes, this is a sell, this is a sell. We already have the perspective of price behavior logic. We already know we're anticipating higher prices. So when we see this selling at 9:30, we're not thinking, oh my god, it's gonna sell. No, price. No, we know exactly what we're looking for. What happens? Everyone's selling. Price is generating liquidity. Price is generating liquidity. The London session low is here, and look how deep of manipulation price gives it. Look, such a deep manipulation. And because we're not trying to catch the low, we're not trying to bottom tick, the beauty of it is we don't need to know how far it's gonna go. And what do? We just simply wait for the confirmation. Then look what happens. Price then starts to turn around, and look, we have that inverse fair value gap here. Will be a nice confirmation. I primarily like to trade market structure because I find a lot more confidence in that. Price gives us a nice market structure shift. We then start looking for 50% or below off that range that price gave the market structure shift on. This is a 1 minute time frame, by the way. And then look, key London session low, the confirmation that price is ready to turn around on the lower time frame. And then look, price starts to trade away. Stop loss would have been below the low, never would have been traded. What would your targets be? Previous session highs, previous day's high, and then this previous session high was the New York session high here. So for me, entering below 50% of this range, stop loss here, to you targeting that high, that would have been about 300 points by the looks of it. Who's complaining at that? And all you're doing is that you're just waiting for the confirmation of the manipulation that is done, and then you're then engaging with price, and that's it. That's the edge. That's what gives you the perspective and the understanding of how liquidity is used within the market, because now we know exactly where we should expect the manipulation to happen, and we'll know from what time it should most likely start happening. And then we just simply wait. We just sit on our hands and we simply wait. And then this is what you're then able to do. Now, for some of you that might be thinking, how do I figure out bias? How do I figure out high time frame buy? Well, luckily for you, I have a 25-part series starting from December 1st, and the first lesson is going to be on bias. So just come back to this channel, and the first lesson I'm going to be posting on December 1st is going to be on bias, and I'm going to be teaching you what I've learned through this series. 9 years of trading ICT, and I'm going to be breaking down concepts each day that I've learned. So yeah, come check that video if you want to learn about bias. I hope you guys found value in this video. If you did, let me know in the comments below. I know I definitely dropped some gems for some of you guys, and light bulbs are going off in your head. Of course, don't take my word for it. Go look at this in price and you're going to see I'm not bullshitting. It's there and it repeats and it's consistent, and that's what you want, an understanding of how price behaves around liquidity and what you should expect if price is bullish and what you should expect if price is bearish. Like, comment, subscribe, and I'll see you guys on my next post, which is going to be on Monday, which is going to be the start of my 25 days of Christmas series. Shout out to ICT for that inspiration, where I'm going to be sharing everything I've learned with ICT for the last 9 years. I'll see you guys in the next video.